Hi, everybody. Hi, Glenn, Shahab. Just a little. Thank you, Sean. I wrote a little poem. Goes like this. Corona, Corona, fear that I'll own ya. Born in a lab in China, spreading so I'll find ya. No one's safe, not even a king, and I'll be the excuse for everything. And then just one more thing on Twitter. This one right here. I showed a little against the wind, Bob Seger. I'm older now, but still running against the wind. VIX 14, 1430 looks like a good entry. And then last night, I was talking about a 25 to 28 objective. I think we tagged 25 last night on the VIX. 24. Heck of a gap. Gap to be filled. Maybe. Some gaps, like the Macron gap, hasn't been filled yet, and that was over, I don't know, 2 years ago, and you had to be short the euro for 1,300 pips. So don't buy that philosophy. There are different types of gaps that Forex traders are not really aware of because of the nature of 24/6 trading. But there are things called area gaps, breakaway gaps, runaway gaps. So not all gaps are the same, Forex gal. Hello, Paul. How are you? So looking at this debacle today, Stell made a pretty good comment. This is not the dip to buy, I don't think, at least yet. Because Blake's back. Okay. So we took out the 50-day. Here's your daily S&P. Took out the 50-day. Usually when that happens, you could have a test of the 200-day. And I have confluence around 3,100. I don't know the path, but I think we're going to get here. The 3,100, there's confluence between the throwover line off the megaphone. See this? And then a little speed line right here. And the moving average is moving up there on the daily, the 200-day at 30.45 now, but heading up towards 3,100. Okay. Kind of an anemic response. Maybe we'll get an ABC. I still think the dollar has one more run in it up here. I'm looking for over par, between par 20 and par 60. Gold almost fulfilled a 78.6 retrace up here. I know everyone's going to say it's a massive bull market. And, we're at 80 here. And we still have major underperformance by silver. Look at gold. Successive new high, silver. Finally, may have taken out some stops here, but it's still a lower high. And actually, when it looks like the S&Ps may begin to recover, I think silver is going to be decent short with stops over this high. I pulled the trigger Friday and scalped it. Glad I didn't take it home. Aussie is trying to grind something out here. I know it's the weak sister, but it's not. You can see we're diverging here in Aussie. It's tempting. I don't do a lot of stuff on a Monday, but this is tempting down here. Euro pound, I think, has bottomed. So what I want to see is, where is EG if we trade 107 euro? And I'm thinking that we could probably have a higher low, maybe around 83.20. So I'm going to be watching for that. What else is there to talk to? Demolishing crude again too. So this was a good call. And Steve Volge and I have been pounding the table on VIX for weeks now. I think Steve's comment was, if you wanted to really screw somebody up because you didn't like them and they ask you for a recommendation, you could tell them to short volatility. And I think that was Friday we were talking about that. So Steve, I hope you didn't sabotage anyone. You know, US dollar yen, the disconnect that happened, I was right about metals and bonds going up, but US dollar yen, I was looking to go up and I got taken out here. This does not look bearish to me. You know, it looks like we could get a pullback, but you know, I have to respect this. I don't see any reason to get short. And some of my stuff is threatening weekly, monthly breakouts here, Tom. And I think we're going to make a move towards these highs again. Now look at these highs on a monthly. You know, they were confirmed. This was one hell of a move, and I thought we were going to get a move back down, but it broke out of a lot of stuff here. I think the ends, you're going to see 120 handle. Yeah, I think that's what may turn the market, is once we have a dollar peak. It's possible that, you know, if we top in here this week or the next week at 100 and start heading down again, that could possibly coincide with a turn in risk. Okay, so Blake is back. He talked about it. We also talked about the Mexican peso at the bottom. And I remember saying to Blake down here, hey, Blake, USD MEX has a heartbeat, and pretty good heartbeat. Also, we were pounding the table that be aware of risk off because of what the yuan was doing. And the yuan is challenging, well, not quite challenging the old highs, but yuan's still looking good. See a weekly on it. Yeah, broke out of this, so it's got one more fan line for it to take out, but here's your weekly. Looks pretty good. Maybe we get a stall at 710, but I don't know why we can't go and take these highs out over 720. We'll see. 10-year yields, not a surprise. If you've been listening to us, we've been talking about it. You're not going to see 10-year trading here, but all the way up here, we talked about it, right? So up here, we needed to get through 2. We all showed the breakdown. It's actually starting to diverge. I know some people are talking about a 135 target. You know, we didn't even really take this low out yet, did we? 143. What's today's? Well, because we're not showing today's low. This is probably Friday. So watch it around 135. And TLT should be making, already has, making new highs for the move. These are new historic highs for TLT. So the narrative was, you know, bonds and gold good, and eventually the market would feel risk off, and that's what's happened. So, you know, I'm just going to throw out something counter before I hand it over to Blake, and I know everyone's going to disagree with me, but I just want to show this weekly on the gold, which I am doing now, but let me go to a monthly. So the bears would say that this might be A and this might be B. I think we traded up to 78.6 here. Not quite the high 1689, but the bears are going to be looking for it to fail in here, maybe even this week. And they'd be saying we could have something like this from up here. And with this being 200 shy of the 2011 high, and you had a quality, that would take it 200 bucks under 1050. That would give you 850. So a very contrarian view, and there's no technical reason. Look at the RSI, still over 80. 78.6 is the only reason I could come up with. Silver's a different story on the RSI. There's a 4-hour on gold. You see that? And here's a 4-hour on silver. You know, could barely get above 70. So silver is going to be the preferred short when that happens. And I hope everyone's okay. I think we did our spec 108.45. Okay. And NC 104. I wish you luck on it. I don't see anything in the end to tell me to sell it. So good luck on it. If I do, I will. Right now, this looks like a flag to me. You know, Steve would say this was impulsive, right? And right now, all this looks like is corrective. So 104
yen seems to have really decoupled from anything that is risk off related. I mean, it has completely decoupled from gold. It has almost completely decoupled from stocks.
Yields.
Yeah, I mean, we saw a move lower on Friday, but compare where it is today and what the S&P and the rest of the indices have done, and
that's the only thing I got wrong on the narrative was you know, lower yields, higher bonds, higher gold, and lower U.S. dollar yen, because that was a correlation that worked till last week or the week before.
I'm very curious to see if this is something temporary, or you know, it's a change of behavior from behalf of the yen.
Well, maybe it's the correlation broke down because of correlation, corona, kind of like a Asian contagion, Steve, like we had. That was financial reasons in the 80s, but no one wants to touch anything Asian, and that includes currencies, and the yen's in there.
Oh, I think during this decade, their time will come to shine again. And I'm not referring to the yen now. I'm referring to the rest of the
I'm just
Asian
talking
currencies.
about the disconnect that you're talking about. They're in Asia. No one wants Asian assets right now. They may not want Italian assets either.
Coronavirus, in my opinion, they shouldn't want Italian assets one way or another.
Really?
Oh, yeah, absolutely.
How about the food?
How about the Ferraris?
Food and cars.
There you go.
Food and cars are excellent, but stay away from the rest of the assets.
Okay.
Italy is a mess. I know. And unfortunately, it also has a huge political mess, which with the current system that they have, it's going to be very, very tough to overcome. So I don't foresee any brighter future ahead for Italy as long as the situation is as is.
Well, you know, I mean, the Greek civilization and the Roman civilization never really cared for each other, did they? Ancient.
One of them emerged while the other one was in decay.
You go. So why you let go of that grudge already?
No, we didn't really have a grudge. Actually, we're very similar with Italians as attitude and mentality, etc.
Yeah. Okay. All right, Nero. Let's see.
Hey guys.
Blake, go ahead, buddy.
Yeah. Hey, good morning, everybody.
Hey,
I just, I have a few minutes that I can spend here this morning. I've got a few things I got to deal with over on my end, but I wanted to just cover just a couple quick things before I turn it back over to Steve and Stelios and you, Dale. You guys were talking about the euro. The euro is still trading heavy. One of the things that I want to point out is that there is expected to be a bunch of the models that the banks are referencing, that there's going to be some dollar selling at the end of the week. Now, banks tend to get ahead of those moves, so you might see some of that, dollar selling midweek. Maybe Thursday, but Friday is supposed to be a pretty big dollar selling day. Like I said, you might get people getting ahead of that move a little bit, but just a little heads up. That might be the catalyst that drives the euro higher. But right as of right now, because of the coronavirus and what's happening in Italy and the acceleration in the transmission of the virus over there, the euro is trading heavy for right now. So that's just something to keep in mind. Also want to point out the dollar mex. We talked about it coming out of this descending wedge. We're almost at the 200-day moving average right now. and the dollar mex has, I mean, we're up over, 1.3% currently, as equity markets have sold off. When, I was asking the guys and gals in our chat room, when's the last time we've been down over 2.5% in US equities, intraday? I can't recall. It's been a while. So, we're seeing the effects of that in like the dollar Mexican peso, which is almost back at the 200-day moving average. We're well back above 19 and squeezing. So, as I mentioned in the week ahead video, one of the biggest positions out there is long Mexican peso, short euro. So, to see the euro Mexican peso squeezing the way it has the last couple of days, this is a lot of position squaring, and it's going to take a long time to get all of that done, especially if the market really wants to square up, which could take us, all the way back towards 1950. But that doesn't mean we're going to do it in one fell swoop either. What I would be looking for specifically in the US dollar Mexican peso is trying to buy it back at 19. If you can get a long, somewhere down here, let's see here, somewhere down here, this would make more sense than trying to chase it up here. But then again, you look at like the daily candle on Friday, that big spike up on Friday, that didn't stop the market today. I mean, today we're significantly higher. So this squeeze can continue. Just, trying to be smart about not chasing the market, trying to buy these pullbacks versus chasing it into some key resistance, the 200-day moving average, big, daily trend line coming into play, that type of thing. Now, you guys also mentioned the yen. The yen has really decoupled, as I mentioned on the week ahead video. Old tricks and ideas of the market will not die easily. I do think that the US dollar, Japanese yen, or the yen in particular is going through a change where it's not going to be a risk on, risk off type of currency, but that doesn't mean that it can't be near term. It's a question of, how far do equities come down and how far does the US dollar, Japanese yen drop? Or how much strength does the yen get on the way down with equities? My assumption would be, as I mentioned on the week ahead video, nothing's different. By the way, if you watch the week ahead video, I'm not saying anything different than I did yesterday morning when I filmed that video. That if S&Ps drop, like, let's say 100 points from where we're currently at, how deep of a pullback is the dollar yen? Because now I think that the dollar yen, you've got to sell yen on these pullbacks, meaning buying dollar yen, buying euro yen, or whatever, however you want to express that trade. I think that's how you have to do it with the yen. You got to look to sell yen as it rallies. So as the dollar yen comes down, you want to be a buyer of that. The question is, again, how far do we get a dip? We're already starting to pivot at some pretty key levels here ahead of 111. I still think that we can drop towards 110.50. I would be a buyer down here if we can get towards 110.50 to 110. The question is, do we even drop down there? That's the question I'm asking, because I have no skin in the game when it comes to the yen. One of the other trades that I just sold my euro Canadian this morning at 143.90. I do think a break above 144 is bullish. If you guys recall, on Friday and Thursday of last week, I was long. I bought it down here at the 143 level. I sold it this morning. I am buying dips. The reason why I'm buying dips is because I believe that the dollar Canadian is going a lot higher. And now on Friday, we closed at 132.20. We opened up this weekend, on Sunday at 132.60. And we're coming out of this pennant. So I do believe we're breaking higher in the dollar Canadian right here. I believe this is going to happen eventually. So even though I sold my Euro Canadian, I am buying dips. So now any dip back down towards like 132.50, I'm a buyer. I'm just looking to, find some good places to be on the long side. That's what I'm looking for now, and we'll see if we can get a dip in this pair. I'm hoping we can, but we'll see. But that's basically what I'm looking at in the markets right now. The dollar Mexican peso, like I said, I think these highs around the 200-day moving average are gonna offer some resistance up here around the 1920 level. And we should see some good back and forth volatility today. And I think that's the key right now, is that we are seeing volatility come back to the FX market a little bit. Yes, the euro is not moving a whole lot. Yes, the yen is a little undecided, but I think you can find, good, volatility in this market. You're going to be able to pick up things on the cheap, and you're going to be able to sell things as they stretch their legs, and whatever currency pair you're dealing with. So I'm happy to see some volatility coming back, not only to the FX market, but also to the U.S. equities as well. I look at the S&P, and this is a big move here. Real key support now that we've broken through 3,300 is going to be down at 3,200. If you are looking to trade the S&P, I think that you probably want to sell rallies back into into 3,300 if you can get it, or 3,280. But be careful chasing it down here. We're pretty oversold, but just remember, we've been going up for a long time. So I think now, as the market is getting to grips with, how much this coronavirus is going to affect, how it's going to affect, the global markets moving forward. I think it's a situation where we look to manage risk by, selling into some of this strength, and, looking to buy dips, and we'll see how far that the equity markets can dip based on the environment that's coming over the course of the next couple of months. But I think you have to be on the defensive. And remember, there are a lot of late buyers in the S&P, Tesla, Apple. A lot of these high flyers have some room to come down, and we've been going up for a long time. So a decent correction may be upon us. So I just wanted to say, be careful out there. I'm going to turn it over to my colleagues. I got to get to dealing with a couple of personal things over here. But Steve Stelios, Coach, it's all yours.
Okay, Blake.
Hey, Blake.
Thank you, Blake.
Thanks, guys.
How are you doing, guys?
Up with the escalator, down with the elevator. Perma bulls were dreaming like of a 50-60% year based on performance of the first 6-7 weeks. And guess what? We're barely 1% above the open of the S&P for 2020. And in my opinion, this has the potential of turning to a double whammy, because I do believe that coronavirus, one way or another, is not going to be a very long-lasting concern for the market. Of course, nobody says that it can last for a few more weeks, right? Or even a month or whatever, which is, a lot. But imagine what's going to happen if the market starts feeling the burn by pricing more a potential challenge from Bernie Sanders, while we're still selling off because of coronavirus and its effects to the global economy concerns. So, that can prove to be quite the recipe for disaster for perma bulls of risky assets. Stelio, what do you say?
Yeah, I agree, and I think we're going to be feeling the effects. I mean, the virus itself, hopefully, will be controlled eventually. Some kind of a vaccine or whatever they're going to, come up with. But the effects of that, and on the global economy, I think it's going to take months
especially to a global economy that is, in real terms, very weak and artificially supported by monetary policy. The thing is that monetary policy can temporarily, and I can't stress that enough, monetary policy fighting real economic issues with monetary policy is a recipe for disaster in the long term. But the point is that coronavirus is affecting the economy from the supply side. And there is absolutely nothing that monetary policy can do about supply side issues. Actually, monetary policy, loosening monetary policy while you have supply side issues is like throwing gasoline to the fire. Because in essence, you create more money to bid up less goods, right? So I don't have a doubt in my mind that central bankers are stupid enough to try to do that, but it's not going to work.
But theoretically, if you have more money chasing after fewer goods, you will get some inflation, and that's what they want, isn't it? They don't care about everything else. Anyway.
I actually, as I've said
just
in the past,
read a piece that
yeah, Coach?
coronavirus patients, after they've recovered, remain contagious even after they've recovered.
For what period of time?
Yeah, I don't know. I'll send you the piece.
Okay,
I just got the headline.
That's
so weird. I mean, that's like HIV.
So Stelio, I agree with you. Stelio, I agree with you. With the only difference being the following: as I've said multiple times, I strongly believe that central bankers do not want higher inflation. They claim that they want higher inflation because if they do something different and inflation increases, which we've seen inflation climb slowly higher, then they will be forced to do something. But if they claim that they want higher inflation comes, then they're not under pressure to actually do something about it, because theoretically speaking, they've said that that's what they're looking for. So as long as inflation doesn't increase, by them claiming that they want higher inflation, they have an excuse for pursuing even more extreme monetary policy. And if inflation starts picking up, then at least they're not under pressure to fight it, because if they actually try to fight inflation, as we know very well, you have two options. You can either fight inflation and let assets do whatever they will do, which we know what they will do if they start hiking rates. I mean, we saw what happened after just a few rate hikes from zero. Imagine what would happen if they actually try to increase rates even further, or tighten monetary policy on other aspects like quantitative tightening, etc., even more. So they do say they want higher inflation, but I believe they don't. But they have to say that because it's a win-win situation for them. Other than that, I agree 100% with you. That is why monetary policy can't work for supply-side issues. So in this case, they can do whatever they want with monetary policy, but as long as there is a big supply disruption due to coronavirus, there is almost nothing they can do about it.
Yeah, absolutely. And as I said before, I think the effect will be felt for months to come. And when you effectively shut down a market like China, who supply the whole world, you can't,
with cheap goods, because that's also important. With cheap goods,
you can't switch your supply somewhere else, with a flick of a button. So I think it's going to be felt. And
plus, even if you can change with a flick of a button, that still means two things. First of all, you will have to go to the second best option, which means it's a more expensive option, which is going to become a lot more expensive because taking out supply from China is going to beat up prices everywhere else. So even if you can, with a flick of a button, switch supplier, to the second cheapest, still that's going to become a lot more expensive than you initially expected.
Yeah.
What else did we have over the weekend?
So, well, we didn't have. I mean, the main event has been the virus and how it's spreading in Italy. And I have
Canadian wholesale trade, by the way, 0.9 versus 0.4. Sorry, versus 0.5, so 0.4 better than expected. Last month's revised a little bit higher. I doubt that's going to move the market much, but it was the only data we had. That's why I switched to that.
Yeah.
Go on, Celia.
We had, I was about to say, we had, more cases in Italy. The thing is spreading. It's far from being over. We've been saying this for days and days. So obviously equities not liking it at all. And I see many comments of people saying, oh, this buy the dip again and again, the buy the dip has worked for the last 10 years. Well, I'm not sure it's going to be working this time. I really don't. I'm not saying that we're going to see a crash, but I think that this thing will have an effect on the global economy, and this should theoretically get translated in stock prices and in
First of all, to begin with, it was a freaking miracle that stocks managed to ignore it for so many weeks. I mean, it was a very weird behavior, because when something is as overpriced, I mean, we have, depends on what kind of metric you look at. The current US stock market, based on some metrics, is the most overvalued ever. Based on other metrics, is like the second most overvalued ever. Based on other metrics, is like the third most overvalued ever. But, on average, let's say, best case scenario, it's like the second most overvalued market ever. So when you have a market that is like so much overvalued, macro are really, really, really looking bad. Fundamentally speaking, I mean, things are really looking bad projecting forward. You have an upcoming election cycle in which
that's the biggest risk in my opinion.
In which so far the market has refused to price in even a little possibility that Bernie Sanders can actually win. And as you very well said many times, Stelio, in any case, when something is almost like 100% priced in, you should always take the other side, right? Because even if temporarily the market starts believing that Bernie Sanders has like a 30% chance of winning, that should count as quite a big move lower, right? Now, add to that a huge, huge global event that's currently happening, which is the coronavirus, which even if we assume the best case scenario, and I really strongly hope for it, because coronavirus is not like a financial event. It's a disease that has a toll in human lives. So even if we assume that coronavirus like starts fading almost immediately, and within like 1 month it's a thing of the past, still the global disruption and the impact to the economy for at least like a couple of months is going to be big, especially when we're talking about a global environment that for every point of GDP, the vast majority, if not all, at least the Western countries, and not only the Western countries, need to accumulate more than 1 point of debt to create it. So under such circumstances, it's, the potential for more downside in stocks is huge. So as I was saying even last week, the risks are extremely asymmetrical. I mean, I don't know why somebody would want to own S&P at 3,400. Could it go to 3,500? Sure. Could it go to 3,600? Absolutely. But, the potential for upside was rather limited looking at the big picture. The potential for downside is extreme. So, why would you want to take that kind of a trade? And, the biggest depiction of that was in the VIX, because the VIX and people that were actually trading the VIX in this occasion seemed to be, much smarter than usually, because even though stocks were pushing to all-time highs, the VIX was, clearly diverging by a lot. And, as we were saying last week, VIX was looking like an amazing buying opportunity, because let's say you bought VIX at 14. Okay, what's the worst thing that could happen? I mean, you could see VIX, move lower towards 12, like within a few weeks. Okay, you would lose a little bit of money. but the potential for an explosion higher. By the way, today we gapped higher to 24, and who knows what happens from there, was extremely higher.
Steve, the only problem with buying VIX for the majority of people
is the contango.
Negative carry. So you have to time it really well.
I totally agree with you, Stelio, but this type of divergence, because it wasn't a discrete divergence,
I agree.
Usually 100%. Points to a quite, fast move. So, I mean, how much of a negative carry would you have to incur for holding it for like 10 days or 15 days?
Oh yeah, nothing. That much, but absolutely right. Absolutely right.
And imagine you bought VIX at 14. You made last week, let's say at the beginning of last week, because of this divergence, you made how many times your money by the jump to 24? And who knows, within the next 2-3 days, this can be at 35.
Yep. Yes, so, very asymmetrical, that's for sure. Yeah.
Oh, completely asymmetrical. I mean, no question about it. Yeah. I was actually very lucky. I bought, I sold the S&P on Thursday at 3,387, 88, something like that. It was half a position because I thought, it could move at the 161.8% extension at 34.14. So I wanted to have some dry powder, but I can't complain because, even half a position, that was quite a nice move. I'm still going to hold on to it. I do like this breakthrough, this wedge. If you look at the NASDAQ, same type of situation, triangle, move out of the triangle to the 227% extension. We've said many times that usually thrusts out of a triangle are, can be terminal. And, I very much like the way it has failed here, and it has completely already retraced the whole move out of this triangle. So, if you bought the breakout from the triangle and you wanted to hold on to it for eternity, within literally 2.5 trading days, you're already out of the money. I mean, you held it for a couple of weeks, perhaps a little bit more than that, and somebody was happy that they made, by buying this breakout, 5.5% almost, and now they're more than 1% out of the money within 2.5 trading days. Not even 2.5 trading days, actually. So be very careful here. As I was writing earlier in our chat room, in my opinion, next downside targets for the S&P are in order. 3,210 is the first one. 3,160 is the next one. 3,120 is the one after that. And then we're going for 3,075. So these are downside targets, which I know that there is, this whole buy the dip mentality, but I think, it might be very dangerous trying to do it after just 2.5 days of downside. I know that, they're going to try to jump in and, fix, in quotes, this market, but sometimes the market is not fixable, at least not in 2.5 days, no matter what the plans protection team is going to try to do. So be very careful here. 3,210 is the next downside support. And, it seems very likely to hit that. And as Blake said, any rebound towards 3,300 is probably going to be a very good selling opportunity for more downside. Now, having said that, the DAX also suffered massively. I mean, the DAX has a massive, almost 4% down day today, after breaking through for the second time. The first one was a false one through this ascending wedge. And probably this seems to be the real deal. It's even more scary if you imagine that this happened just after a few days that the market managed to break out and hold above all-time highs, this previous double top that we had here. Now, managing to break to all-time highs, then consolidating for 5, 6, 7 days, whatever that was, to all-time highs, unable to move much higher, and then breaking down in such a manner. I mean, today, we might have a 4% down day. Must be pretty scary for those that were, buying the breakout. So, things with indices look quite hairy here. So I would be very careful trying to buy the dip already. I'm still holding on to my, short position, and I don't intend to get rid some of it here. I'm actually willing to increase it to a full position at any decent rebound that we might see from here. Now, can this fail as a tactic? Sure, anything you do in trading can fail. But personally, I feel quite fine about it. Now, I know that, a massive amount of people have been burned trying to sell the rallies in gold. But, I'm sorry to say this, but this market is not one market you should be selling. Now, nothing moves in a straight line. Gold is going to have pullbacks. There is no question about it. Gold is going to even have decent pullbacks on the way, absolutely. But keep in mind that people were looking to sell this market based on sentiment, positioning, technical events, since we were like below 1500 and we're almost $200 above that. So, if you were trying to short at 1500 and at some point gold pulls back for, $100 from, let's say, 1700 or 1733, I'm not mentioning 1733 coincidentally. It's a nice confluence of the 78.6% fib from the all-time high and the 261.8% extension of this last corrective move, this triangle that we had, its range. So let's say it sells even, let's say, $100 from 1733. You still haven't made any money if you were trying to short it from 1500. So
Steve, on the weekly or monthly charts, 1698 is 78.6 back from the 2011 high to the 1050 low.
Yeah, here it is.
1698. Oh, you have it there. Okay. 78.6. You have it at 1732.
Yeah, it is at 1732.
I had 1698. Huh.
Any chance that you didn't draw the line?
Yeah, it's possible the magnet slipped from my shaky hand and I didn't get the right high or low.
1733.92 is where I have it.
Okay.
Let me.
Don't trust my fibs, guys. I have shaky hands.
1733.64 to be exact. I now made sure that it's from the high to the low.
Okay.
So yeah, I mean, we might easily make it there. Don't forget that since we were consolidating in this little flag, which was below 1500, I said that I believe that the 61.8% fib at 1586 is going to be hit once we get out of that. Not only we've hit that, but we're on our way to the next target. And most importantly, because that is extremely important, remember what I've said since a long time ago. Gold has been hitting week to week all-time highs against most of the currencies. Yeah. So it might not be at all-time highs against the dollar, but it is at all-time highs almost against everything else. So there is unquestionably a bull market here in gold, unquestionably. Now, as I said, nothing moves in a straight line. So I'm not advocating that if you haven't been long gold since this breakout at 1360, that you should try to buy gold at 1677. No, I understand that it makes no sense. But what I'm saying is that, be very, very careful with trying to short this market, because, you can easily get burned. Very bullish markets like this one can go more overbought than you initially expect. And, sentiment can become more extreme than you initially expect. Positioning might become and stay at extreme levels more than you would expect. Now, if you want a similar example, just look at the freaking S&P. I mean, S&P has been having periods that it's been, at extreme bullish sentiment, for months at a time, a little bit lower, a little bit higher, positioning the same thing, or positioning in the VIX being extremely short, etc. And the S&P has suffered, for example, only for selective periods of time, and usually very short-lived. So why do you think that the same thing can happen for gold, especially when the global mix of conditions is so in favor of monetary metals, especially gold? Now let me go through some of your questions. Let me open the question box and see what you have here. So I'll take it from the start. Let's go. Euro yen, USD yen. Okay. So first of all, USD yen. I obviously wouldn't be playing risk off through USD yen because first of all, we've broken out from a multi-year trend line resistance, and unless this proves to be a false break, why try to short something that has just probably triggered a major technical event? Plus we see that yen has really lost its connection with risk off for the time being. So how do I know that it's going to return really fast? So I have to say that I wouldn't be selling USD yen here. I wouldn't be buying it either. But I wouldn't be selling it. So personally, I'm staying away from the yen. Now, having to do with euro yen, since you asked about it, euro yen, and you can see it here, euro yen hasn't yet proven that you can trust it to go higher. It has stalled at the 61.8 of the last move lower. It's still trading below this broken ascending channel. So I would totally understand why somebody would want to try the short side once again, as long as we stay below, let's say 122. But if we go back through this channel, then I think that it's going to be very dangerous being short here as well. Until that happens, the risk reward still favors short positions. Do you think the dollar has any correlation with the NQs? By NQs, what do you mean? US 10-year yields at new multi-year low. Yes, and remember, I've said since some time ago that my target in this move in the 10-year yield is actually even lower. I'm targeting this little, it's not exactly a confluence, but these two levels fall very close to each other. As you see, let's say it's roughly at 125. We have the 161.8% extension of this rebound higher, and we also have the 161.8% extension of that rebound higher. So, both of them, more or less at 125. One of them is 128. The other one's like at 124. So let's say 125, 126 is the average.
Goodburn's looking for your 1.618, 109, 110.
109. Okay, yeah, not unlikely, absolutely. Yeah. But my
when
first
he
target
said
is
it during the interview, I went, "Holy shit!"
Yeah, and the 30-year at all-time lows at 1.84. Be my guest. Go ahead and loan
short the bonds
and lend money to the U.S. government for 30 years with a yearly return, which is already something like 0.6% lower than the reported inflation. And I want to stress the word reported. So, I mean, if there is one bubble, this is it. If there is one bubble, this is it. The reason this is like probably the craziest bubble in financial history ever is the fact that one thing is for sure. If you're buying bonds here, you're bound to lose money. You have to choose which way you're going to lose money, but you're bound to lose money. And I know that, very few purchase bonds and hold them to maturity, in which case you're guaranteed to lose money. But even bonds changing, hundreds and thousands of times hands until they mature, still, on average, the average person that will have held this bond at the end, at maturity, will have lost money. So,
these are the lowest rates, I heard someone comment, in 1,000 years.
Doesn't really surprise me.
I'm not
really extreme, familiar with financial history going, let's say, 800 years back. So I don't want to, play the smartass. I haven't studied financial history like, let's say, of 1200
around in 900? Wasn't that the Dark Ages?
Of the Dark Ages, yeah, exactly. But you know, I can tell you as a fact, more or less having a good idea of financial histories, let's say since let's say
maybe yields were dropping during the bubonic plague.
The end of 19th century. I'll have to admit that it seems like a very, very, very stupid concept to me. I mean, buying bonds here. And if only we knew which is the actual inflation, in which case, you know, by having actual inflation and not reported inflation, this would seem even a stupider endeavor than it currently is, right? Now, having said that, I'm still bullish the bonds. I mean, you know, bubbles can get even bubblier. There's no question about it. At some point, this bubble is going to implode. And when it does, it's going to be probably the biggest financial event that will have ever happened in history. But, you know, nobody says that it has to be today or in 6 months from now. So, you know, bonds still look bullish. Yields look like they, you know, they will keep moving lower in, you know, at least in the short to medium term. From a technical perspective, that's how it looks like. So it is what it is. And usually that also has bearish implications for risk assets. We had already seen.
I see him at.
Yeah, we had already seen a period that stocks didn't respond to yields. I mean, to their usual correlation. And, you know, as I was saying at some point last week, you know, this divergence has to close one direction or the other. Now we know which direction is attempting to close by risk assets trying to catch up with the move lower in yields, because we had this divergence. I was showing it at some point. I think it was at the beginning of last week or at the end of the week prior to that, something like that. So it is what it is. I did some fundamental work. Conclusion: expecting the X 100 at expecting the X 100 at 8,000. Yeah, I mean, why not? I mean, it can happen, right? By the way, DAX still unstoppable. I mean, it's already 0.1% lower from the last time I talked about it, and keep in mind that we're now like below 3.8% lower on the day. I mean, above 3.8% lower on the day. S&P almost at the lows. Here is NASDAQ, by the way. Massive day, looking like it's about to unfold here in the NASDAQ as well. 3.1% lower as we speak. VIX 36% higher on the day so far. So, you know, quite in FTSE 100, 3.6% lower. Nikkei, almost 3.9% lower. Spanish stock market, 3.9% lower. Australian stock market, 3.3%. Even Nifty, 2.1% lower. So, yeah, it's quite a red day today. Hi, guys. Good morning. Could you evaluate pound CAD? Do you think there is a head and shoulders formation on the... Let me see. Pound CAD. I think you should look elsewhere. I mean, pound CAD isn't doing much here, right? I mean, might be attempting to break down from this ascending channel, which that would be quite an interesting event. And I do see this little head and shoulder you're talking about. So yeah, it can move lower from here. But I mean, now that we finally have some volatility back in some assets in the market, I would have to say that you know, probably you have other instruments that look much more interesting. Plus, why would you want to be long the Canadian? Because in essence, you know, by being short pound CAD, it's like you want to be long the Canadian when USD CAD has broken above this little pennant. And if it also breaks above 133.30, which would mean that it's breaking above a formation that dates back to the end of 2018, that's going to be a very bullish event for USD CAD and a very bearish event for the Canadian. So I have to say that, okay, let's say it makes sense, risking a little bit here, but if you see USD CAD above 133.30, don't be long the Canadian dollar, in my opinion, almost against anything. So, that's what I think about it. Oh, by the way, speaking of risk assets, keep in mind, I showed that in the chat room a few hours ago. Crude, as expected, seems to be failing here. And we're talking about a big failure here because look at this. Whoop. Didn't mean to do that. Okay, look at this. Rebound within what looks like a flag. And today indicates a big failure, especially if we close below this channel. You can be looking for new lows in crude towards 46.5 to 47.5. In that vicinity, I would be looking for the next support to be found. So crude, definitely big failure here. We had a warning at the end of last week when we retested that 54.50 area. If you remember, I was looking for crude to fail anywhere between 54.50 and 55.50. 55.50 was the 38.2% fib of this move lower. It failed at 54.50, and from what it looks like, I think it's going to be printing a lower low sooner rather than later. So having said that, because there is a question about the USD NOK, clearly, as long as crude is under pressure, USD NOK is not going to really be able to do very well. USD NOK at highs. Keep in mind, though, that the closer we get to this ascending channel, which dates back at the very beginning of 2018, so it's already a more than 2-year-old channel, right? This ascending channel. So the closer we get to this channel's resistance, the better the risk-reward ratio is going to be to actually take the other side of this, right? For something like this. So, start paying a little bit attention because, we're not that far away from this channel anymore, in which case I wouldn't be surprised at all to see like a big rejection from there. Percentage drop important. Sorry, to what are you referring, Forex Gal? I mean, which instrument? Feeling the burn, good one. Yeah, the stock market must begin pricing in higher probability of a Bernie Sanders presidency. Absolutely. And if you remember, we've kept warning about it since a month ago, that at some point the stock market will have to start pricing in even a small probability of that happening. The stock market refused to price in even a small probability of Bernie Sanders being the candidate and having some chance of winning. And, as I've said at some point, keep in mind that might be a vicious or virtuous, depends on which side of the market you want to be, circle. In which sense? If the market starts pricing in a Bernie Sanders win, not as a certainty, as a small percentage, let's say it starts pricing it in initially as a 20% chance, right? The market will have to start moving lower. The thing is that the biggest thing that Trump has to present is asset prices and stock market gains. So the more the market starts pricing in the potential of a Bernie Sanders victory, the worse the chances for Trump to win the next election are going to become. And then the market will have to price in a higher chance of a Bernie Sanders victory, which will again reduce the chances of a Trump re-election. So you understand what I mean? This is going to be a vicious circle. If it starts happening, then it might be quite tough to reverse, right? Because the lower the stock market goes, the lower the chances Trump is going to be elected, the higher the market is going to have to price in a Bernie Sanders victory, the lower the market is going to have to move due to that. Because I think there is no disagreement, no matter how you view the markets, there is no bullish case scenario for the stock market with a Bernie Sanders victory. I mean, Trump supposedly is promising more tax cuts, both on on corporate and personal level. Bernie Sanders has said multiple times that he wants to increase taxation. That on its own is enough. Look at the global supply side of macrolane antibiotics, Zithromax, known as we can only treat so many patients. Yeah, that's a valid point as well, Scott. In Swiss, we have negative interest rates, so you get punished when you hold too much cash on the bank. Yeah, I know. That's why I have no idea why people in Swiss don't only hold gold, if you're asking me. In this case, not only you would be avoiding paying up money to store your fiat currency, but you would have actually made a killing. Thank you, my friends. Great input. Go to rush for the dentist. Okay. Have a
good root canal. And
have a painless appointment. Steve, U.S. market PMIs exercise the fallacy that U.S. is immune. Fed to cut rates by 50 BPS. There's no question about it. I've said many times, the Fed's next move is cutting. And if you remember, I was one of the very few that in 2018, I was saying that the next move from the Fed is not going to be to hike when the market was pricing in 3 or 4 rate hikes, but it is actually to cut rates. And, everybody was mocking me. But
you should have won the Nobel Peace Prize in economics that year, Steve, in my humble opinion. And Matt Weller is here.
Okay. VIX, understand the asymmetric issue, but I'm not sure if your recommendation is to buy or sell. My recommendation was to buy the VIX because there was an asymmetric benefit in being long than being short, for a short period of time. Aussie USD, platinum. Sorry guys, I know there are a lot of questions, but we had a lot to talk about. I'm going to cover the rest tomorrow. I don't want to bleed into the interview anymore. Since
you're hemorrhaging, you're not just bleeding, you're hemorrhaging into
it. Okay, so be here tomorrow, and we're going to cover the rest of the questions. And of course, for ForexAnalytix members, we're always going to be in the chat room. And if you're not a ForexAnalytix member, now that we have some nice volatility, this is your opportunity. Go sign up. You're going to have 10 days to spend with us for $1 as you're testing what we can offer to your trading, and you can see what kind of input you get from the chat room as well. Thank you, Coach.
Yeah, you're welcome. Spend your fiat. Okay, Matt, it's been too long since I've talked to you. I'm talking years, and I'm getting you set up now. And I'm unmuting you. And if Steve stops sharing, you could share your screen. Hello, Matt Weller.
Hey, Dale, how you doing? It has been
my God, what's it been, 5 years or so?
It probably has. Yeah, it was a previous iteration of this webinar, but hopefully we can start making this a more regular thing.
Yeah, it was FX Street. Okay, and you were there, and your prayers were with me when I was going through a difficult time. I hope the 5 years have treated you well. It's great to have you back, Matt. And what a day for you to be here. So there is a green box for you to be able to share your screen to talk about the markets that are on your radar if Steve will stop sharing his screen. Steve, are you still here? Okay, let's see.
Yes, Coach, sorry. I'll stop sharing.
That's okay. There you go. That's okay. Okay, so Matt, there's a green box. If you hover your mouse over the drop-down menu that says share.
Yeah, working our way through my typical technological
inability.
There we are. All right, you guys see me here?
Yeah, there we go. So let's start off with the dollar in the face of what's been going on here. Take it away, Matt. Tell me what you're seeing here. I always liked your clean charts. It's all really sticks and moving averages, right? That's what you use.
Yeah, absolutely. I think a lot of traders go through different journeys with their charts, but the one that kind of works for me, and I think I've seen a number of other very successful traders do, is you learn about all these indicators. You don't want to miss anything, so you start slapping on, RSIs and MACDs and stochastics and Fibonacci's and Elliott wave counts. And at a certain point, you just have so much on your charts that it can kind of overwhelm the signal at the end. You're never going to get every indicator in agreement. And even if you do, that doesn't guarantee a successful trade. So I've kind of switched back to simpler, cleaner charts, and that's worked for me and maybe some of your traders.
Yeah, that's a problem. Analysis paralysis. You're right. You never get everything to line up. It's all a probability game. So what are you thinking here, Matt? We've had a nice run in the dollar. People have talked about the dollar entering a bear market several times, and the dollar always bounces back. Do you think that par is in the cards here?
I do. I do. I'm relatively bullish here on this is the dollar index, of course.
Right.
And I think I caught the tail end of Steve's interview, and I agree with him that the Fed will likely be cutting rates, which, and I do think about 2 this year is my current expectation, probably in the second half of the year. Usually that would be a headwind for a currency. Interest rates tend to have a direct correlation, but we have to remember that all currencies are a relative value game. So if the Fed, cuts interest rates, say 2 times this year, in a vacuum, that might be negative for the US dollar, but we have to compare it to some of its major rivals. And I think you look at Europe, you look at Japan, you look at UK, they all have their own economic issues, and in fact are deeper into the stimulus from a monetary side to try to promote their currencies. So I think, or promote their economies more so, it's really hurting their currency. So
okay. So you're excellent with fundamentals. You're excellent with fundamentals. So I have a question here, and it's something I've noticed with my call for lower yields in the U.S. is that yields have been falling faster. If you look at the Bund and you look at the 10-year note, yields have been falling faster on the 10-year note than the Bund. So isn't there the beginnings of an interest rate differential beginning to start to move in favor of the euro, with the Bund not falling as fast over the last, say, 4 or 5 months as U.S. yields have?
I think that is, and that is maybe something traders are looking at. This chart is not really, I need 2 axes here. So this is not really supporting your view yet, pin to scale on the left scale. So this is roughly what you're getting at. And if we look maybe more so at a shorter term basis, you have the German 10-year yield in blue and the US 10-year yield in the candlesticks here.
Yeah.
So they've been keeping relative pace. I do think your point is well taken that on a very short-term basis, there are some differences there. But as we look at it, all these major central banks have to cut interest rates. So I think the lackluster growth in Europe and the fact that they're already at the lower bound, there's only so many tools in a central bank's toolbox, if you will, and Europe is already reaching deep in there and using some of the least effective tools, in my opinion. Things like extreme quantitative easing with no end, negative interest rates, whereas the Fed still has a little bit more ammo there that is more likely to be effective in stimulating the economy if it comes down to that. So for that reason, that's kind of the fundamental appeal of the U.S. dollar.
So it's kind of like a catch-up move in the U.S. to what's been happening in Europe for a long time.
Yes, exactly. That's my view. As much as it doesn't feel like it, the Fed in the U.S. has been a little bit, I don't want to say ahead of the curve, but maybe ahead of some major rivals in terms of addressing this very slow, stagnant recovery from the great financial crisis. So some of these tools have been at least moderately effective in the U.S., whereas Japan and Europe have been perpetually even further behind the curve. So maybe transitioning back here to the U.S. dollar index, this is a daily chart, and the key level I'd be watching at this point is around, and I've got the wrong scale on here, regular. Let's just remove this scale.
Who are you working with nowadays, Matt?
This is a good chance for me to plug. So I am the global head of research at Gain Capital, which of course is Forex.com in the U.S. And then we also have Forex.com brand in other regions as well as City Index. So I've been here on and off for 10 years. Thank you. Yeah.
You were a young guy when I first met you.
I know. Yeah.
You're catching up to me.
Yeah, I'm chasing you down in gray hairs. We
right,
just
man.
had our first child, so I've been getting gray hairs at a record pace.
Your best long-term position trade?
We'll see. Maybe not financially, but she'll be picking my nursing home one day, so I think it's got good benefits.
Good one, buddy.
So yeah, the key level I wanted to highlight here on the dollar index, 99.40. That was roughly resistance that we saw back here in September and October. We broke above that level last week, and we were just really getting stretched. There was a lot of demand for the U.S. dollar, I think, both from a safe haven perspective and from that relative yield advantage. As you said, it hasn't been changing that much, but it still has a positive carry relative to, especially in the case of the dollar index, you're talking about the euro. So I think that sentiment by the end of last week was a little bit excessive, and we saw a pullback here to the short-term moving average. I used the 8-day exponential moving average, but we also saw a pullback to that previous resistance level at 99.40. So I'm not surprised that we're seeing the dollar find a bit of support so far today, and this area here will be what I'm watching on a short-term basis. If we do break below, I'd still be pretty bullish on the U.S. dollar, but I wouldn't be surprised to see a deeper drop towards, say, 99 or the mid 98s in the next week or two. And that perhaps could present a buying opportunity for similarly bullish traders. But as long as we're staying here,
you have a long-term upside target for the dollar if it continues. I mean, there are super bulls talking, 107, 110. Are you in that camp, or is 102 something that you see as much more achievable?
Yeah, if I bounce this out to a weekly chart here, basically the highest price we've seen the dollar trade at, and man, if I zoom this out, this has been over a decade now. That the highest price we've traded as this 103.50 area.
Yeah.
For that reason, I don't think we're in kind of this massive, secular, profoundly bullish U.S. dollar environment. I just think it's the best house in a bad neighborhood right now. So 107 sounds a bit extreme for me. We'll see what happens. Obviously the dollar could go down, even using relatively few indicators. You're never going to be correct on direction every time. But I think in time, if we can get over this parity level, then a move up toward 103.50 could be in play.
Okay. A lot of people are scratching their heads, myself included, because of a correlation breakdown last week in US dollar yen, because normally in risk off, when gold's going up, US dollar yen's going down, and when yields are going down, normally, it was a safe haven play to for a stronger yen and shorting US dollar yen. Knowing fundamentals like you do, is this a new paradigm that's occurring here in the end? What are your thoughts for these correlations breaking down? Is it just because of Corona and no one wants to touch anything or belong any Asian currency right now?
I think that's a big part of it, Dale, to be honest. It's I think you're correct from a macro sense. If we have general concerns about the overall global economy, I still do think the yen could benefit, certainly not to the extent the US dollar has. But what we saw last week was that the fears went from global to specific idiosyncratic fears about the Japanese economy. Last week, we had that, I think it was a minus 1.6% quarter over quarter GDP reading. So that's projecting over a year. If we saw that continue to be a minus 6% contraction in Japanese GDP, this is the third largest economy on the planet. Like, this is really massive news. And it was likely caused by temporary factors, a sales tax increase. In fact, the last time we saw such a big contraction in Japanese GDP was back in 2014, the last time they raised sales taxes. But then we also saw, in addition to that fear, pockets of coronavirus popping up in Japan. So if that starts to metastasize, if it leads to the sort of factory shutdowns for a very heavily manufacturing-oriented economy in Japan that we saw in China, then that's, I think, what spooked traders when it comes to Japanese assets, and including the yen. That was more than enough to overcome the broad macro safe haven bid that would usually be going to the yen. And traders were just like, well, I might as well just buy the Swiss franc or the US dollar if I'm looking for a macro safe haven trade, or gold, of course.
Okay. So I know you wanted to cover gold, and I think you mentioned that. And gold has been a home run ball from the breakout at 1380, 1360, and starting to get that parabolic look to it. What's your take here? I never believed in chasing anything, and I actually think there might be something counter trend setting up here difficult. I actually think silver's relative weakness will make that a preferred short for a reaction. Where do you think gold's going, Matt? Are we going to take out the 2019 highs of 1900?
Potentially in time. I would not expect that immediately. And just to sort of set the scene, around the middle of last year is where I started to get very bullish on gold.
Yeah.
And that was sort of historically informed. I don't mean to offend anyone here, and I know people who trade gold often have very strong opinions. But at the end of the day, for me, gold is not producing any income. You know, it's to say it trivially, it's a yellow rock, but it's a yellow rock that's held its value for thousands, if not tens of thousands of years. And what drives that value are things like real interest rates and frankly, just sentiment. So we saw, and this is a very zoomed out weekly chart here going back years, but we saw for after things went crazy, you know, and gold got up to that 1900 area from about 2013 to 2019, gold did nothing. It was just chilling here between, you know, 1100 and 1300. And that really, I think, just got everyone sick of gold. You know, even the hardcore gold bugs, it was increasingly hard to make a compelling case for gold. And when you have that widespread apathy combined with low expectations for price moves, that can kind of set the stage for the next big move up. And then, of course, we have just the perfect macro environment for gold. There's low real interest rates, so there's low carrying cost for gold. You're not giving up much by buying gold. You can't earn, you know, 10% in your bank account like you could historically. And we have all these central banks resorting to extreme, untested monetary stimulus measures. So longer term, I'm certainly a bull on gold. I had a colleague, Fawad Razakzada, project in his bold prediction for this year that gold could go to 2000. And we were making that, you know, toward the end of 2019. So we were trading, say, here at 14 or 1500. And to me, that's a pretty bold prediction that such a massive asset could rise 30-40% in a year. And it's looking like it's on track, to be honest. So
knocking on the door.
Give him credit.
Who made
as
that
far
call?
As I'm sorry. Oh, that was my colleague Fawad Razakzada.
Okay.
He's actually since departed the company, but you could find him on Twitter.
What a revolving door this business is.
There's a lot of turnover here, but you know, it's just like the markets. There's a lot of turnover in the market, so it's always compelling. So maybe to get a little bit more short term perspective, just since we've started seeing this up move in gold, maybe the start of 2018. If we just measure this move, this is something I did just this morning to try to get a framework for kind of how gold's been moving over the last year and a half. We saw a big rally here off 1160 up to, let's call it 1350. But what I really wanted to highlight is that's about a 16% move. Then we saw a very shallow, controlled pullback.
Nice.
If I can pull a fib on here, you probably can't see it too clearly, but I'll just highlight that we've pulled back to the 38.2% fib retracement and then resumed the uptrend. That means we rallied very strongly in a relatively short period of time, only pulled back about 33% of that move, and then started rallying again. What did we see from there? Another decent size rally, in this case, about a 23% rally, pulled back about 33%, right to that 38.2% fib toward the end of last year. And it looks like we've seen another very similar surge. If we just see how far this move has been so far, this is what gets me a little nervous from a short-term bullish perspective, and kind of would support your view, Dale, is that we've seen a 17% rally. So that's right between the range of these other rallies. Does that mean we can't go higher? Absolutely not. Maybe this takes us all the way to 2000 if something weird happens. But I think the probabilities are starting to favor a pullback. And keep in mind, these previous pullbacks have only been about a third of that previous move up. So it's not my preferred direction to trade. But if you are an active trader, if you're comfortable with that sort of counter trend move, I would be looking at the price action, because we're clearly stretched relative to the moving averages. I would be looking for some sort of candlestick pattern that could signal a potential reversal. And that way, what really makes counter trend trades, because you're trading against the trend, so it's naturally a lower probability of success, all else equal. But if you can get a really strong risk to reward ratio, that can overcome that slightly lower probability. And I know many traders who are very successful trading like that.
You know what I gleaned out of that, Matt? The pattern of only 38% retracement, 38.3, is like the character of the market now for years. So I would say to people that if and when we get any kind of correction in the market, that anything deeper than 38.3 would be saying the character of the market is changing. So to me, that's a real pearl that you noticed both of those corrections being one of the smallest fib retracements, more in time than price at 38.3. Thank you for that.
Yeah, no, I've used that terminology too, the character of the market. And I think that has broader applications beyond, just one specific thing. But if you've identified so far, this uptrend's been doing approximately this, if it does something substantially different, it doesn't mean the uptrend's over or that we're going to necessarily see a reversal, but it should raise your antenna and have you thinking, how is this changing? Should I expect what happened previously to continue? Perhaps not.
Yeah. So this bloodbath in stocks today that bears have been looking for about 10 years. And, we're finally getting a correction. I don't think it's the end of the bull market. Some people are saying it is. You have any kind of ideas of, 5 to 10% type of correction that we're going to have from here? We haven't had a 10% in a while since, I think, December of 2018, 2019 in there.
Yep,
What's
absolutely.
it look like? What's it look like to you?
So this is the S&P E-minis contract here. We're not quite at the stock market open yet, so we'll look at the futures. Again, maybe we can use that same context here, the character of the market, and I'll slap my longer-term 200-day exponential moving average on here.
Okay.
Since the start of the fourth quarter, we haven't really even broken below the 50-day exponential
finally
moving
today
average.
Yeah, we did
today
last
it looks
night.
like we're going to open there. We've seen, and I had a colleague mention, would it be shocking if the S&P 500 closed higher? And I think it probably would, but we have seen so many of these scares where things gap down, they look very scary, and just gradually throughout the day we grind higher and then see a furious rally at the end of the day and kind of close higher. This has been truly a Teflon market that shrugged off all of these concerns. So I've been burned too many times trying to call a top. Classically, the trend is your friend until it changes. But again, using that same context of the character of the market changing, it might be reverting to the character we saw through a lot of last year, where we would see deeper retracements toward a longer term moving average. But again, this 200-day EMA continues to trend up, as do for the moment.
Where's it come in? Around 3,100?
Present. We're looking at 3080. Yes, sir. So I'm not even saying necessarily we will go down there, but if we do, that's kind of the test for the longer term character of the market. And again, that's from here, that's another 150 points here. So another 5% decline. I think we're already 4% off the highs. So that's right about a 10% total decline to take us down to that area. And that could be in play depending on how the news flow goes. And
I didn't want to get political, but you brought it up. You said burn. Oh, you said you got burned. I thought you were talking about Bernie Sanders.
I hopped on for...
you have the burn?
I hopped on for Steve's closing thoughts, and he took something that's been bouncing around in my head and really stated it articulately, and that's that historically, going into presidential elections, one of the best determinants of who's going to win is how the stock market performs in the August to November period. So the last 2 or 3 months before the election has predicted, I think, if it's up, it has favored the incumbent party, and if it's down, has favored the challenging party, with I think an 85% accuracy going back over the last relatively small sample size, but over the last 30 elections or so. And I think Steve correctly mentioned that there's a feedback loop there, where if the stock market remains strong, well, people are going to be happy. They're going to want more of the same. Trump is more likely to get elected, especially after staking so much of his reputation on economic performance and the stock market. Whereas if we do see the stock market start to fall, maybe that decreases Trump's re-election odds and could increase the likelihood of the Democratic candidate, which in turn they might be seen as less business friendly and could exacerbate that fall. So I really do think as we move into the third quarter of this year, we'll start to see more volatility in the stock market as traders try to front run each other. And if we do see one of those circles develop, it could offer a lot of trading opportunities.
Two angry men on the opposite side of the fence.
Yeah, a bunch of old angry white dudes.
So, Matt, anything else you wanted to cover market-wise? Because I want to give you some time to show our attendees and people to see the video later where they could follow you in your research. Maybe you could show your link that you have on Twitter to be following your work, if you want to do that now, or talk about another instrument. Up to you.
Yeah, probably never want to miss a chance for a plug here. As I mentioned at the top, I'm the head of research for Gain Capital. I don't know where most of your viewership is from, but in the US, we offer a Forex.com brand. If you want to see what I'm thinking about markets and what my colleagues around the clock are thinking, you can go here to the market analysis tab on Forex.com. And latest research, we're going to have reports up all throughout the day, nice. Covering the latest. Of course, today it's all about coronavirus. And of course, if you're in different regions, City Index would be the one to get. Again, I'm not sure where your viewership is primarily, but I do want to quickly plug that I will be at the London Trader Show this week on Friday. And that's somewhere in West London. So if you just Google London Trader Show, I think it's relatively cheap to attend. Would love to meet anyone who's interested in talk markets. And then finally, if I can get my last plug out of the way, probably the best way to stay up to date with myself would be on Twitter. I'm at MWellerFX, so MWELLERFX. And then, of course, the around the clock, the Forex.com team at ForexCom will be sending out tweets and really putting some of these market moves into context and helping traders learn how to trade. So with that plug out of the way.
It was great hearing your voice again, my trading warrior brother. Really.
Absolutely. Yeah, I'd love to be back on one time. If I can just mention a fundamental factor that I think will determine a lot of what happens here with, for instance, the S&P, with the dollar, with gold, some of the major things we've talked about. It would be coronavirus cases, obviously, but it would be specifically ones outside of China. I think the markets kind of determined that the cases in China are being treated seriously. We'll see, ultimately how this turns out. I'm not an epidemiologist or anything like that. But what really I think could throw a wrench in the works here are some of these outcroppings we've seen, especially this weekend in countries like South Korea, Italy, and last week I mentioned, of course, in Tokyo. So I think this is from Johns Hopkins. Yeah, here it is. Tracking, it's kind of a cool dashboard to track the cases. And specifically this part down here shows the cases in mainland China in orange, recoveries in green, which I will note just quick at the top, recoveries are increasing relatively quickly. But what we really want to look at is these other locations. This looks super minor right now. It's super low compared to how many cases we've seen in China. But if we slap this into a logarithmic chart that shows the exponential growth better, we can see that it's tracking in terms of other regions at the same percentage gain. In fact, over the last week or two, at a higher percentage gain than we've seen in China. So this puts it in a little more context. If we start to see, some more of those infections perk up, that's where traders are going to get more scared. That's probably where we'll start to see a deeper retracement in the S&P and where we could see things like gold and the US dollar benefit, in my opinion.
What do you think of this, Matt? Corona, fear that I'll own you. Born in a lab in China. Spreading so I'll find you. No one's safe, not even a king, and I'll be the excuse for everything.
Did you just come up with that off the cuff? That was
I wrote it over the weekend.
Nice. I like that. You're a poet, and I didn't know it.
Yeah, I didn't either. I have Longfellows. Anyway, Matt, really great talking to you, and let's try and make it every month or so that you come back and share what you're thinking and your clean charts and great fundamental views. Thank you for edifying faith today, Matt.
Will do, Dale. I'll reach out and we'll try to get a more regular thing going on moving forward. Thank you, and best of luck with your trading, everyone.
Good hunting, Matt. Everyone, Matt Weller. And I want to thank Matt for being with us. We'll see everyone for Turnaround Tuesday, and be safe. Good hunting. Adios. One more thing. Don't forget, don't just count your pips, count your blessings. See you tomorrow. You're welcome.